All right, we got some work to do here because we got to figure out what the heck just happened to the Fair Isaac Corporation stock. The analytics software and service company best known for being the keeper of the FICO score, Fair Isaac. After a really hot start earlier in the year, the stock came down substantially over the past few weeks, thanks to worries about rising interest rates. Higher rates translate into less borrowing, which means less business for Fair Isaac, theoretically. Last night, something interesting happened. The company reported a fantastic quarter, sizable top and bottom line beat with accelerating revenue growth. Management also raised their full-year forecast across the board. I loved it. Unfortunately, the stock got hit, plunging more than $80 or almost 7% today, because even though Fair Isaac raised its guidance, it wasn't enough to catch up with Wall Street's estimates. See, people already expected a beat and raise quarter, and they're still very much worried about the long-term interest rates going higher. So could this be the buying opportunity we've waited for a high-quality company that very rarely comes down? Let's check in with Will Lansing. He's the CEO of Fair Isaac, and get a better sense of the situation. Mr. Lansing, welcome back to Mad Money.
Thanks so much, Jim.
All right, so Will, let's just deal with this right up front. I mean, to me, all of your metrics were exceeded, and it was really a quite beautiful quarter for FICO.
We agree.
Well, I mean, then why do you like my analysis that perhaps you didn't raise earnings enough, estimates enough, that they were unhappy?
So,
the they being people who really don't understand your company as far as I'm concerned?
Well, I'd say the part of your analysis I certainly agree with is that there's a buying opportunity here. That's the part I agree with. And I agree also that the numbers are fine. I mean, we beat guidance and we beat consensus, and we're happy with the results. I do think that there's a little bit of an overhang from a fear of interest rates not coming down quickly enough. Earlier in the year, certainly people thought the rates would come down sooner, and with lower rates come higher mortgage score volumes, which is good for us. So any kind of postponement in rate decline is obviously going to clip us a little bit. But generally, we're very happy with the business. We're in a good place.
Okay, look, and I agree with you that it's the higher for longer, trap people, and gets people who I think are a little too small-minded about your stock, gets them to do something that I disagree with, which is not love your stock. But I also have in my hand a letter from a fellow by the name of Senator Josh Hawley. Now, I was brought up by my mom and dad to think that because there's only 100 senators, you better revere him. But when I read his letter, which was to Jonathan Cantor, the Assistant Attorney General, he's talking about monopolies. Well, there are more people doing what you're doing than ever before. It's just you have the best one. Why can't this senator see that that's what's going on?
Well, and you are exactly right. I mean, we don't have a monopoly. There are alternatives to the FICO score. But what we do have is the best score and the lowest cost and best way of evaluating credit for a broad population at the low cost. And so there are people who, get concerned about our level of success because we do have a lot of market share, and we are widely used. Over 90% of credit decisions in banks in the U.S. are driven by FICO scores. So there's a reason that people notice it. But as you point out, there are alternatives, and we're there because we're good, not because we have some kind of special privileges.
Well, also, look, there was a period where a lot of these upstart companies came on, and that's actually using the analog in the name, that said, hey, listen, they don't do 360. They just drill down on one thing. You got a 360 product, too. From what I can tell, it's better than anybody's.
That's exactly right as well. So you have to distinguish between the scores and the software. We have two businesses, scores and software. And at the end of the day, what we try to do with both of them is make these superior credit decisions. The scores is a low-cost, broad population approach. And the software says, let's take into account lots more inputs into the decision, a little more sophisticated, a little fancier, a little more complicated, and a somewhat more predictive decision as a result. We have both available. And so it's important to compare apples with apples. There are a lot of fintechs who have new technology for making credit decisions. Typically, they start with a FICO score, and then they build on top of that with whatever their secret sauce is.
Well, that's what I thought. I mean, we discussed, say, an outfit like an Upstart. I mean, no one's impeding them. They could be in every bank if they were better than you. I mean, I think a senator may just look at the situation. There have been more competitors that have been created that tell me, listen, they've got the algorithms and FICO doesn't. That I understand this maybe 10 years ago when the competitors weren't around and you were the best. But now this is the most competition I've ever had you see, and yet you're winning constantly, and that's what matters.
That's absolutely right. That is right. look, the FICO score is going to be used for a very long time. It is the most predictive, low-cost way to evaluate the creditworthiness of a large population. We do it. We do it at low cost for our bank customers. And, what I'm proud of is it enables us to get credit into the hands of almost anyone who can responsibly handle it. We score more people. We get credit into the hands of the people who deserve it. And I'm proud of that.
Well, the only reason I'm dwelling on is that your stock did get hit on the letter because people, I think, are a little unsophisticated about your situation. They seem to think that you make a ton of money per mortgage. I mean, the fact is, you take about 20 basis points. I mean, you can't even see it.
That's also true. Now, it is the case that mortgage scores, FICO mortgage scores, are pulled for almost every mortgage, both conforming mortgages and non-conforming mortgages. But the FICO score as a percent of the total fees that a consumer pays for mortgages is tiny, 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 tiny.
Now, one of the things I did do over the longest period of time was to see what's happened when your stock has had this drop. And I know you should be very proud. Every single time when you have this big a drop, it's been an amazing buying opportunity. I don't see anything else other than the fact that I think it was a mistaken sell-off. And I say that this is right. And I know you agree with me that, but I'm not kidding. Every single one of the sharp dips has been accompanied by a multi-year rise. And I think this is just another one of them.
I think that's exactly right. You're spot on. Inevitably, there's bumps and dips in a stock. Ours has generally been up, 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 and up. And most people have trouble getting a hold of the stock because they find the PE exorbitant. We think that it's fairly priced based on our future prospects. But when you get a dip like this, it's certainly an opportunity.
Right, one last question. You have not been contacted by Mr. Cantor's office, have you, the antitrust office?
No. And I think it's probably worth pointing out that there was an antitrust investigation by the Department of Justice several years ago, and we came out clean. I mean, there's not anything inappropriate here. We're squeaky clean on competitive practices, and there's nothing to be concerned about.
All right, terrific, because that was the only other thing I said was, well, maybe they reached out and we don't know about it, but I didn't think, I know you would have disclosed it immediately. You disclose everything. You're a totally upfront company. Every footnote answers every question. So I want to thank Will Lansing, Fair Isaac Corp. President and CEO. We love this stock. This is our chance. It's the first break.
Thank you.
Thank you, Will. Good to talk to you. Everybody's back into the break.
Coming up, you asked and we answered. Cramer turns in homework on a classic American company. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.